Europe has had all of the bludgeoning, apparently, that there is to be had, at least for this week over there. It's a bloodbath. And so they've gone off, and that liquidity is gone. And to your point, things need to even out now, which of course saves the S&P from a really critical break. It was just about to clear that range bottom there that we've seen hold up basically since October of last year.
And we're bouncing back. I mean, we're not recovered. The market has been dealing with the pressure of $90 oil at points throughout the trading day. The headlines out of the Gulf region continue to get worse. Qatar telling us that they may have to, the broader Gulf region countries may have to halt all energy production if there isn't a ceasefire or slowdown or reopening of the Strait of Hormuz in the coming sessions. We also had the non-farm payrolls data this morning, which points us in a not so happy direction, Ilya. Maybe the bad kind of inflation. Not that there are many good kinds of inflations in the world of economics, right? There's inflation, deflation, disinflation, and then that old bugaboo stagflation, which has a really specific meaning. And I want to get to that because we're not in a stagflationary economy. But stagflation is the trifecta of three things. It's when you have high unemployment, high inflation, and low or contracting growth. Okay. Right now, not all of those things are in place. A 4.5%, 4.4% unemployment rate, as today's jobs data showed us, is obviously not stagflation. 4.4%, in fact, is the number the Fed sees in the unemployment rate settling at this year. So kind of right on the nose. But we already know that inflation's up prior to the invasion of Iran and the U.S.-Israeli attacks there, which if you're following the news today, the 82nd Airborne canceled military exercises in Fort Bragg, Florida, which is raising more eyebrows about a potential boots on the ground scenario. So with oil having crossed 90, there's likely going to be a very significant knock-on impact to headline inflation over the next few weeks. Look no further than AAA gas prices to see that. And then you sprinkle in a minus 92K jobs report here, which we may want to explain away because of strikes or weather in the Northeast corridor. But Ilya, I want to talk about this number here on the bottom, and that's where I want to point you. Minus 69K on the revisions. So this isn't just a single data point. This is now a series of data points that show us that the labor market is much weaker than previously thought, and it's moving in the wrong direction for whatever reason, temporary one-offs, what have you.
Well, this is what Chair Powell has been warning us about for months now, right? Is we got a sort of talking to about there being a systematic overcounting on the economic data. And we had Chair Powell say, look, whatever number you get out of BLS, on average, subtract 60. And that's the real number. And he was explaining this as he was talking about the very large revision, again, annual revision to NFP last year, saying, why do you guys think we want to cut rates? We know these numbers are overreported. We know the labor market is weaker. We're aware. It's why we're telling you there's going to be rate cuts. And then there's a big revision, and he goes, you see, what did we tell you? So you look at this number and you go, okay, the Fed's messaging since January has been they did the rate cuts. The labor market is improving. They saw 130K in January, which, by the way, was not terribly revised this time. It was revised mainly for December. January only came down from 130 to 126. So maybe the Fed's onto something. Maybe they're ahead of the ball again. What they're saying is, look, the labor market already has the support it needs. We're good. We can hold off here. Now we need to watch inflation. And if we're watching inflation, go ahead and take a look at where crude oil is. That's inflation. And so it looks like the market is looking at all of this and going, yeah, they're going to cut, but they're not going to cut soon.
They're going to cut, but they're not going to cut soon. And that is probably the biggest takeaway from the market's action this week when we take a look at the Fed funds futures over the next several minutes. We'll see them shortly when we get over to our section on bonds, Ilya. Yeah, it's an inflation shock. Oil going up 25%. It's roughly 10% of the CPI basket. So you're thinking about a 2.5% increase in contribution. And given pass-through lag and weighting, you're thinking about a net CPI impact of maybe 0.5% on the low end to 1.5% on the high end over the next 2 to 4 months. So all this talk in the market about a potential June rate cut now is going to run into the very real window where we go March, April, May, June. Okay, so just as the Fed meets for that meeting where they give us a new summary of economic projections as we head into the summer, more importantly, maybe the first meeting with a new Fed chair, although maybe not. Either way, we're now looking at them going into that.
Tillis on Twitter now that the Ayatollah is no longer a pen pal and the vacancy is there. You should start a correspondence with Tom Tillis. See if we're going to get a new Fed chair.
Doesn't follow me anymore. So someone's going through the social media and switching pages. But we'll talk about that later. This inflation shock, right? It's going to arrive right as the Fed has to make the decision when the market was thinking the next cut would come. So you're seeing September, October, November really being the focal point in the market now for when we would ultimately get that cut if it were to come at all this year. But we have to entertain the scenario that maybe the cut doesn't happen.
Could be.